I'm John Kaiser at the Metals Investor Forum in Vancouver, May 27th, 2023. I am speaking with Sandy McVey, CEO of Westvault Mining. Sandy, welcome to Vancouver.
Thank you. And welcome to Vancouver to you as well. It's been a wonderful show so far.
Yes, it has. And the weather's been extraordinary. Now, Westvault has invested roughly $50 million in the Hasbrouck project since acquiring it in 2014. How much of that was added value exploration cost? And if you were to start today, if you were to acquire the project as you did in 2014, how much would it cost and how long would it take to have the project where it is today?
So we acquired the project from the troubles that Allied Nevada was going through in 2014, 30 million US. We paid 20 million down. 10 million was possible to be paid for the outstanding 25%. We bought 75% of the project. Ultimately, Waterton picked up the 25%, and we've had them as 25% partners till about 2 years ago when they accepted the 10 million, and now we're 100% owners. So it's about a 30 million over time that we spent on acquisition. 20 million over those years from 2014 to now has been spent on increasing the quality of the project. We got it from Allied with a very basic PEA, but very good geology and very good metallurgy. And that's what we liked about it. So we bought that, and we have spent our money not on drilling. We did a little bit of drilling, but it was pretty half-hearted effort, and our hearts weren't in it. We were more interested in developing and getting into production. And thereafter, once you're in production, doing further drilling to extend out. Thereby, we would not be matching together the high risk of exploration, which we all know is quite a high risk but high reward potentially activity, with a very low risk project, which is what we were wanting to buy. The majority of the 20 million we've spent over the years has been on engineering and permitting, social license, those sorts of things. And we've worked very hard to get the permits as fast as we could. 2016, we had the federal permit for the first pit, so we did that in 2 years. We delayed getting the federal permit for the second pit. We only started in about 2017. By 2019, we'd got that. So fully permitted federally, we have all the key state permits: water pollution control permit, reclamation permit, all 3 air permits. Those are the key ones. And that allows us to say, I think, very safely to say that we are ready to construct right now. We're not at study level. We are at a level where we are construction ready. We've got construction plans. We've got a level 3 construction schedule. We have current quotes on the key components. That's our status at the moment.
So if you were bought out tomorrow, that party could literally begin construction almost overnight if they wanted to?
They could. As I say, my background, John, is building things. I'm a mining engineer. I've been in construction and mining. And the plan that I'd put together is my plan if my directors came to me and said, Sandy, go ahead and build it. So our CapEx is what I regard as my budget should I get that instruction. It's not going to happen with our current ownership, with our current share structure. Our plan is not to build, but it is ready to build. I could go ahead and start construction tomorrow. I've got a 12-month timeline to construct to first pour of gold. It's a very simple project.
And do any of these permits have some sort of life to them, a limit to them? If you lose them, if you don't use them, is there anything like, because this is a waiting game between the producers and you with this virtually shovel-ready project. Can some of these permits decay on you?
It's a good question. Federal permits have no timeline. They last forever as long as there is no significant change to the project.
Okay.
The state permits, you have to keep paying your fees every year. Every 3 to 5 years, depending on the permit, you have to renew. As long as you keep giving the state the money, they're happy to keep renewing. So yes, you can lose them by not paying your fees, but if you pay the fees, there's no way that the state is going to say, we don't want this permit to go forward anymore.
So when I started researching Westfault earlier this year, I was delighted that you had updated your pre-feasibility study in January, because in the last few years, we've seen inflation make a comeback and OPEX and CAPEX. And based on the new numbers, your stock really should be trading in the $1.50 to $2 range, just as a waiting game for a buyout that might be somewhere in the $5 to $10 range, especially if gold develops an uptrend. For this reason, I made you a good spec value and adopted Westfault as a favorite of Kaiser Research. It trades in the 90 cents to $1.10 level. And so I've been asking myself, why is the market not assigning fair value? And I think it's because the market thinks producers want a 100,000 ounce a year future mine with a minimum 10-year mine life, and yours is 72,000 with an 8-year mine life as it's currently configured. Is there any exploration expansion potential left that could extend the life or perhaps increase the throughput rate, though that I guess would jeopardize the permitting that you've already got in place? And are there any synergies with nearby projects where combining the Hasbrouck and Three Hills could achieve these thresholds that a major or even intermediate would want to achieve?
So great questions. Every investor has to say, well, what is the opportunity? Why am I buying this? I want the share price to go up. And you put your finger correctly on, well, what's it going to take to get recognized? The value gap, we're at 0.2 times NPV at the moment. And by peers, you'd have to say it'd be more than that. I'm constrained from saying how much more, but you can say what you believe it to be. But there is definitely a value gap there. That much is obvious, and I think I'm safe in saying that. How to uncover that? Yes, we know that companies and investors like projects that cut across 10 years. They cut across gold cycles, if you like. That's nice. They also like projects that are maybe more than 100,000 ounces a year. We know that. We're at 70,000 ounces a year. Not far off, but again, we're 8 years and not 10 years. So how do you increase that if that is a key decision maker for maybe somebody, a key decision point for a company that is considering acquiring us? You would have to say, well, there are several ways of getting bigger. You can go and buy somebody else who looks kind of like you, push them together. That's something that we've considered. You can explore, and we would not prefer that due to the mismatch in the risk profiles of exploration versus owning a construction-ready project. Low risk, but pushed together with high risk. You might end up diluting the one with the other. The right time, in our opinion, operationally and from a share point of view, would be you explore when you're in production. So get it in production, and then the property we've got, it's about 12,000 acres. It's a big land package, and there is land all around us that we could acquire in addition to that, or some future owner could. It is prospective. Geologists and the previous owner's geologists have identified a number of drill targets. So we could get bigger those two ways. One, by getting together with some other property somewhere else, nearby maybe, or we could expand by exploration on our property. Now, the potential for nearby synergies, your viewers might remember that Centerra, about a year ago, bought Goldfield project. It was then called the Gemfield project from Waterton. They spent $206 million cash. They wrote a cash check for $206 million. We would have almost certainly taken that $206 million if they'd offered it to us for our property. They didn't. But But the Goldfield property is there. It's permitted. It's ready to build. Waterton got all the permitting. It doesn't have as strong economics. It is smaller, but you put them together, and now you're at over 1 million ounce recoverable. And I always talk about recoverable ounces because the recoverable ounces are the stuff that pays your cost. Resources and reserves are conceptual in a way. I guess that's just the mining engineer in me talking. So you could do that. And they've just got a new CEO there at Centerra, and I'm sure that individual is going to want to figure out what's what before something happens. But, we stay close with those people, and it's possible that something might happen. For me, that has always been a very nice synergy to consider, those two properties, because they're so close. They're 17 miles apart. Allegiant, they're drilling one of these days on their east side project just to the northwest of Tonopah, not very far from us. They're going to, I'm sure, find something that will turn into a mine. So there's that. BlackRock, they're contiguous with our property. Their border touches our border in Tonopah, and they keep drilling, and one day they will have a mine there. So there are a number of nearby opportunities, plus the opportunities of maybe more distant projects that might go together with Hasbrouck to get up a little bit bigger.
Mm-hmm. Okay, so one final question. In the 4 decades I've covered this junior resource sector, I've heard this endless story about gold is good as a hedge against inflation caused by fiat currency debasement. But from a junior perspective, an optionality play, ounces in the ground, or even exploring for a new discovery, gold just keeping track with inflation doesn't really make it better. In fact, if you take $400 gold from 1980 and inflation adjusted, it should be just over $1,500 today. So you have a little bit of a real gain. But from a gold owner's perspective, they would have lost 40% or so of that gain and lost that buying power due to the collectible tax in the United States if you sell your gold to get money to buy something or whatever. So gold itself is not that great an investment for an individual, but the leverage that comes with a real price gain. For example, if say inflation stayed subdued at below 5%, and gold cranks to $2,500, $3,000 without the costs and the costs escalating along with that has tremendous leverage. That would have, for example, for your company, that would have a 4 or 5-fold impact on the NPV versus the sort of 25% increase you get as a gold owner. Now you have a very impressive shareholder base of gold bugs, and your chairman is Peter Palmito of Sun Valley, which is your largest shareholder. What is their thinking in terms of what could produce a real price increase for gold rather than just gold tracking inflation? And I personally am arguing that the world order is changing. It's fragmenting into the sort of the China side, the US side. The US dollar is going to not be the single reserve currency. And I expect gold to become a transitional asset class bridge as this unfolds, and that will drive higher. But what are your people on your company thinking? What's their thinking in terms of a higher real price that really makes Westvault a $10 plus buyout candidate?
So Peter Palmetto would articulate this strategy. It's his strategy and his view on gold better than I can, but I'll do the best I can. Simply put, Peter believes we're in a secular bull market for gold. And, somehow there's a little bit of a credibility gap when you look through the windshield looking forward versus looking in the rearview mirror. $3,000 gold, and we're less than 2,000 at the moment. That seems harder to conceptualize than looking in the rearview mirror, where we were at 1,100 gold less than several years ago. We're now at 2,000. We've doubled in the space of a very few short years. So conceptually, you overcome your emotional barriers to the fact that gold will go higher. And that's where we're coming from. Now, that's the first driver. It's going to do Hasbrouck very well. It's undervalued at the moment, and the gold price will push that up. There are two other dynamics. The second is Peter Palmetto does that classic thing that people do, whether it's Thomas Kaplan or Ross Beatty or Frank Giustra or whoever, buy low and sell high. And he bought low, and he will sell when the price is right. So he's on the side of all the shareholders in Westfold. Any person who might be wanting to buy Westfold can take comfort in the fact that there is total alignment between my chairman, Peter Palmetto, and their interests. They're all shareholders. They're not people who are interested in, lifestyle, jobs, and so on. So that's the second dynamic, is the undervalued nature of the property. And the third dynamic is the one that gold is valuable because it's scarce. If there was lots of gold around, it'd be the price of lithium. A lot of lithium around. It's so many dollars per pound, whereas so many thousands of dollars per ounce. Gold is becoming more and more scarce. If you just look at the charts of exploration discoveries, the amount of gold that is being discovered versus the amount of gold that is being produced and mined, you can see that that's the third dynamic which is acting in our favor over time. Fourth is the one that you mentioned, which is the geopolitical situation, the geoeconomic tension between China and the United States. So you've got a lot of things which are all giving you a lot of reason to believe. You've got this nice little project. You've got a 51% IRR after tax at $1,790 gold. It's got a good NPV. It's got a very low initial capex of $66 million, which I've said before in this interview. I believe I can do it for that. That's not a nonsense number. I can do it for that, I believe. So you've got a very sweet little project which is safe, and it should benefit from one or more of these factors all working together. And it just brings to mind, you did suggest it was good that we had updated our PFS. And we knew we needed to do that because 2016 was the previous study we did on it. Costs were getting a little bit stale, but gold had increased. So in 2016, our NPV after tax was, our IRR after tax was 43%. We're now at 51%. No change in the project configuration. So that does indicate we are more leveraged to the price of gold than to the increasing in costs. So there's another dynamic that as we go forward, yes, cost will increase, but gold will go up. It will benefit this project more because it's more leveraged to the price of gold than diminished by the increasing costs.
Yeah, I think for ordinary retail investors, buying Westfold is a superior alternative to buying gold if you are bullish about a higher gold price. So thank you, Sandy, for being part of the Metals Investor Forum, and thank you for being here.
Thank you, John.